Welcome everybody to the Momentum and Agility webinar run by the Business Desk in association with Clearwater International. My name is Andy Staples. I am the Yorkshire editor for the Business Desk, and our panelists are James Croxon, the Corporate Finance Director for Clearwater International, Amy Piershod, partner at Gordon's, James Foster, head of PE and VC for the North and the head of Leeds corporate team at Shoesmiths, Barry Jackson, the head of Yorkshire at BGF, and Adrian Rolls, director at Santander's Structured Finance and Financial Sponsors business. Welcome, everyone. Initially, we're going to take an overview of the M&A sector as it stands in Yorkshire at the moment and what it may be looking like in the coming months. James, do you want to lead us off on that one?
Yeah, look, I think the sort of title of the meet kind of suggests what we want to talk about. I think there's real reason to be kind of positive from an M&A outlook for the calendar year 2023. There's lots of kind of doom and gloom if you read the press around probably Q4 last year and leading into this year. And if we're not careful, we could all talk ourselves into a kind of big recession and depression. But look, there's lots of positives out there. There's lots of PE with money. There's lots of great businesses to be invested in. And I think, we can kind of hit this year with some real momentum and get some deals done.
James Foster, do you have anything to add to that on an overview?
Yeah, I would agree with that, and I think one of the really significant factors that we have at the moment is we have the benefit of the pound being very cheap, which makes UK assets particularly desirable. And we're seeing a lot of sort of inbound work and international acquirers sort of circling around some of the more sought after UK assets. So yeah, I agree. I think it's time to be cautious, but cautiously optimistic is probably how I'm viewing the sort of start of this year.
I think as well, you've got to take some context to the position, and 2022 was a really strong year for Yorkshire and the North East, and M&A volume. I think that coming into 2023 builds a lot of momentum and confidence as the year progresses.
Amy, what are your thoughts?
Yeah, I think we've got to kind of put it all in the round, really. And coming out of the pandemic, there was just so much deal activity going on. So I think, we're always going to just feel that little bit quieter as we kind of level out into to perhaps something a little bit more normal in a lot of ways.
Barry?
Yes, not dissimilar, Andy. Probably along the lines of what Adrian said. I mean, 2021 was a massive year in M&A, and 2022 was always come off the back of that. From a BGF perspective, it was still actually our second highest investment year ever after 2021. And you look at the whip and the pipeline at the moment, particularly in Yorkshire and the North East, and there's definitely still a reasonable level of activity. I think it all just feels lower than it was, but that's because 2021 was a real anomaly in terms of just the sheer level of volume and activity, I think, in that year.
But before we move on, I forgot to mention at the beginning that attendees can ask questions through the webinar Q&A function. We are keeping our eyes on any questions that may arise, so feel free to ask our panel any questions that you may have. Before we move off sort of the general overview, what about the macroeconomic factors that we're looking at the moment? Interest rates are higher than they've been for a while, but in the overall scheme of things, how does that look? Shall I start in reverse order this time? Barry, have you got some thoughts on that?
Yeah, I mean, the most obvious sector that's acutely feeling at the moment is consumer and leisure, and anything sort of related to discretionary consumer spend. And certainly what we've seen is really from sort of May last year, we started to see a bit of a reduction in some of our existing portfolio companies. And then, businesses that we were looking at investing in, suddenly trading gets a bit tougher, and therefore it's quite, it's a bit harder to raise capital at that point in time. So that's the sector that continues to, I think, be hit the most hard. It's a bit of a cliche, but the good business, there are still good businesses there, and that we've still got businesses that are outperforming the markets. It's not universally across the board, but I think it's fair to say it's tough at the moment. The converse to that, of course, is those sectors that aren't directly exposed to consumer spending, such as B2B businesses, particularly around technology driven. They continue to do well, and are viewed as pretty robust places at the moment. So actually, the demand for investing in those types of assets has arguably gone up, because there's less of a market to go for, if you like, with some of the sectors that are hit particularly hard.
Amy, you've been doing quite a bit of work in the tech sector. Is that something that you would recognise?
Yeah, absolutely. I mean, there's a huge focus at the minute on the sort of regional tech hubs, of which Leeds is a really important one. And obviously the government, they've come out and said they're really keen to back innovation. I think there's been a commitment to increase public funding in R&D to about 20 billion, and that's to enhance strength in things like AI, fintech, green tech. Fintech in particular, obviously Leeds is really well known for. And we are seeing kind of investment in tech businesses in the north. I think it's something like 5 times what it was before COVID. My own team, I head up the startup and emerging companies team here at Gordon's, and we advised on deals investing something like 140 million into kind of tech sort of EIS, SEIS level businesses last year. So that there really is, it really is on the rise.
Adrian, I think you're more involved in the corporate side of things. What's the appetite like for acquisitions among the corporates at the moment?
Yeah, I think there's huge appetite for corporates, and as James alluded to earlier, with sterling being relatively weak, prices are good if you're buying from overseas. So we're seeing a lot of activity from US investors. Also from UK PE and seeing opportunities. I think and Barry alluded to it as well around interest rates, and they're at record highs, albeit they're where they used to be if you've been doing this for long enough. So yes, the cost of borrowing has gone up, which may mean that debt structures are slightly lower, or investors take a different view. But it's about finding that partnership with vendors of businesses and especially within those businesses to get the right structure and the right advice when you're going in. And really it comes from my perspective then to that stability and confidence in outlook. So or you've got an expectation of where the coming years will be. And I think in the last quarter particularly, that stability, and if you start looking at forward yield curves, that stability has really come back, and that volatility has reduced. So investors can see more confidence coming through, and taking view on the debt structures and the transaction structures that they want to take forward.
James Foster, is that reflected in PE and the venture capital side of things as well?
I think it is, yeah. I mean, one area that I'd like to touch upon, I'm interested to see if others are seeing the same, but there seems to be a lot of kind of corporate carve-out activity at the moment, where corporates are maybe looking at sort of siphoning off non-core divisions, and divisions that might be fairly profitable, or resetting, or just looking to slightly diversify. And I think that in itself drives PE opportunity and PE activity to pick up bespoke divisions with a good management team, and kind of go again as their own sort of independents. And we're seeing a lot of kind of corporate carve-out activity at the moment, and I think that's something to continue.
And James,
sorry.
Go
I was just saying, James, I think that's fair, and I think that's what we're seeing as well. A lot of kind of leadership teams are being quite self-reflective at the minute, and just kind of seeing what it is that they need to do to kind of thrive and survive, sort of thing. So yeah, I think we've been doing a lot of the kind of internal reorganization work as well.
James Croxon,
Yeah, look, I mean, it's certainly stuff again that we are seeing. It is an opportunity for these kind of large corporates that might, in carving out kind of non-core assets, non-core parts of the business, it gives them an opportunity to kind of generate some value and maybe rationalize a bit of their balance sheet. Particularly, they can use that cash to either reinvest in kind of core parts of their business. So it is something we're seeing definitely creates opportunity for private equity to invest in these businesses, because quite often, whilst non-core to corporate, that specific corporate, they are in their own right great little businesses with good management teams, and often those management teams are super keen to grow those businesses and take them forward. So yeah, it definitely creates opportunity in the market.
So with investors generally being interested, looking for deals, where obviously Leeds is one of the big startup hubs, and a good number of startups are looking to grow themselves in order to sell some or even all of the business. What are investors looking for at the moment? I mean, I've been reading that ESG is assuming much greater importance. James Croxon, again, I think that's your area of.
Yeah, look, I think first and foremost, most investors are looking for kind of stable long-term revenue streams. That's a large part of the reason why some of the kind of more tech-focused kind of SaaS businesses are doing pretty well on the market, because they've got long kind of visibility and long-term recurring revenue. But as a general theme, there is definitely much greater focus from investors on the whole, all of ESG, and actually, depending on how well you're doing it, it can be a value driver in deals, but it could, it can also be a value drag if companies aren't taking it seriously and or doing it properly. And it's not just a case of giving it lip service. Companies really need to have a proper ESG policy strategy and be actually doing what they say they're doing. And in those instances, that can genuinely add value and add a turn on multiples that are being paid for businesses.
We're certainly seeing it a lot more just via the due diligence. Corporates and PE houses now have got a real kind of refined interest in probing into ESG policies and what's really being kind of done over and above the policies. I think one thing, but it's how those policies, we're being asked as advisors to really kind of dig into the detail on.
I think lenders are trying to support this as well, and giving benefit through ESG ratchets and documentation now to drive those behaviours that clearly we all want to see and adopt. So we did our first ESG sustainability-linked loan in a private equity transaction last year as well. And, we're seeing huge volume coming through in that, both from businesses that are ready to take that on, but also businesses that are progressing to that stage. There's provision put into documentation now to enable that to be activated at the right time.
Yeah.
Carry on, Amy.
I always interrupt you. I'm so sorry. I was just going to say, obviously, I think when we talk about ESG, we often, first of all, just think about environmental policies, but obviously the S is for social. And I've noticed the last couple of years of real uptake in not just kind of what we're investing in, but who we're investing in as well. So I'm part of an organisation called Fund Her North, which was set up in response to the Rose Review a couple of years ago, just looking into how much harder it is for female founders to receive investment. So I think now there's around 30 to 40 different kind of funders that have actually signed up to Fund Her North to help female-backed businesses, just level the playing field in terms of getting investment. So I think on all sides, really, there is a conscious effort to have ESG at the forefront of corporate activity, which is great to see.
And how much does it, we've talked about the environmental and the social, how much does the governance aspects of this impact? So are we looking at, are investors looking for greater transparency, for more solid management structures? Who wants to field that one?
Yeah, look, I think it absolutely permeates through all of ESG, and governance is just as important as the other two strands. And actually, businesses are encouraged to track all of the use KPIs to track what you're doing across the whole spectrum. So there's no one strand that's any more important than the other one. It's kind of a package, and you've got to be doing it all, and you've got to be doing it all right, and properly, and monitoring it.
We're seeing a lot of external challenge and review and reporting as well coming in from, that's driven by investors and lenders' appetite within this to ensure things are being done properly and getting specialists involved to support that.
Yeah, and I would say about the governance as well. I mean, it's often an institutional investor coming on board is a trigger for a sort of upgrade in the governance, if you like, for entrepreneurial-led businesses. There's an increasing amount of awareness from the businesses we're backing about diversity as well, and particularly diversity on their boards, and in particular having more female directors. So one of the questions we get asked when we invest, and we will often introduce chair candidates, and the request is, well, is there, can we have a more diverse group of chair candidates, or if we've got to recruit a new finance director or someone, is that an opportunity to increase diversity? So it's not just an awareness with people like us, as in the sort of institutions, the professionals, the professional community. It's increasingly an awareness through corporates as well, and entrepreneurial-led businesses actually, which normally you wouldn't necessarily have associated with having an awareness of things like ESG, but we are seeing that more and more now.
Barry, what would you say makes a business attractive to an investor? Or perhaps I should rephrase that. How would a business make itself attractive to an investor, or to a buyer?
Yeah, well, I mean, it's sort of expanded on what James said around having sort of long-term stable revenue streams. I mean, a business has got to know what it's good at. It doesn't mean to say it has to have something completely unique that nobody else does. And that's a question we often challenge ourselves on. But it's got to know what it's good at, and it's got to have a sensible plan for growing the business over time, which is typically through growing revenue and profits, but in different areas can be attributed to other aspects. And I think when they've got that, and management understand what the plan is, and that's a proper, well-considered plan, then at that point, speaking from a fundraising perspective, they are in a position to come out and talk to investors. And actually, if you've done the preparation in advance, and there's a clear market opportunity, et cetera, then generally those are going to be well-considered conversations where both sides get something out of it. Where that can fall down is where management go and talk to investors, bankers, where they don't do the preparation first, and actually, they're not able to articulate the message, and then it does actually become quite difficult after that point. Once you've met someone for the first time, and if that has created an impression in an investor's mind, then if they then go and get advice and then come back, 6 months later, it's quite hard to change that view. So I suppose there's one thing having the proposition, the opportunity to grow your business, but raising capital is not easy. And what I'd always advise people to do is to take advice, basically, and make sure that they're giving themselves the best possible chance to get the right outcome for them and their business.
And what would be some sources of good advice there? I mean, would it be from organizations such as yours, or should they be looking for something before they flag up on your?
Yeah, I mean, for BGF, we do, we make investments off market, where there isn't necessarily an advisor there, and that's kind of fine, and we can do that. But often you might have a management team that have been through the process before, so it's a bit different. I think where someone hasn't been through the process before, then it is, it's corporate finance advisors, without, I'll save James's blushes, the likes of Clearwater, but there's many others out there, and there's James and Amy on the legal side, and it is having those conversations early, just to making sure you're as prepared as possible before you're going out to market and talking to people like BGF or Adrian on the banking side. Paint the business in the best possible light, really.
Yeah, I think that supports in the diligence process as well now, and we're seeing that investors and lenders are the swathe of diligence reports that are being undertaken to demonstrate that stability in a business. It is increasing again, and therefore having that support in place, both from an advice perspective, but also on some of the data side of it is hugely important.
Yeah, I mean, we'd say outside, before you even get to a point of appointing an advisor, as a shareholder groups, positively encourage shareholder groups to talk to each other. What is the plan? You don't have to have you could have 3 to 5 year plan. If your 5-year plan is to exit, what does that look like? If that means you all want to exit at that point in time, then you've got to do quite a lot between now and then to, whether it's bring on another tier of management who might buy off you, whether it's to, there's a whole host of different things. But actually, if all shareholders around the table are open and honest, they can all have diverging plans, and some might want to stay on, some might not. But as long as as a collective, they all know what they're aiming for, you can kind of work towards it. And at that point, then you can take some advice on board. There's a whole myriad of options you can, in terms of realizing value for the business. But just would encourage all shareholders to always have a plan and always review it. It might change. You might have a 5-year plan. You might have set a 5-year plan 2 years ago. That might be totally different now. There's nothing wrong with changing that. But as long as you're all bought in as a collective in terms of where you're going, what you're trying to achieve.
And I think on the legal side, it's about a bit of housekeeping. If you've got key people within the organisation, then make sure those key people are tied into sensible service agreements or employment contracts. If there's multiple individual shareholders, perhaps a shareholder agreement's a good idea. It's tight. If you've got key customer contracts, well, again, to tie down that revenue stream for a few years, you might want to think about putting in place, some fairly robust contracts with those customers or suppliers to kind of protect the goodwill that you've got in your business. So it's kind of, some of it is just a bit of housekeeping, getting yourself ready, investment ready, and getting your house in order.
Amy, you do most of more work, I think, than others in the entrepreneurial startup and SME field. Are firms generally aware of this? What's the sort of the quality of prospects that you're seeing at the moment?
It really depends kind of what stage they're at. I mean, if it's a tech business, there's usually quite a good awareness around IP and kind of particularly around the code and things like that. Obviously, businesses have to be really careful when they're using things like open source software, just so that they can go back and demonstrate, how the product has come about. We do see quite a lot of people using third-party developers, contractors, things like that. So do try and spread an awareness of how you're best dealing with them from a legal perspective. But when you're an entrepreneur, obviously there's only so many hours in the day. So I do appreciate when people kind of want to say, "Oh, where's your register of members?" and they say, "What's that?" That is quite common, really, just because everyone wants to be ready, but at the same time they've got to prioritize making a go of the business as well.
And what is that sector looking like at the moment on the M&A front? I mean, obviously, startups are wanting money. Some are happy to raise that through equity. Others are looking for alternatives. What's the general sense in there? How is M&A operating in that sector at the moment? Sorry, that was back at you again, Amy. Sorry, as a follow-up. Sorry, I didn't specify. My bad.
That's okay. Yeah, I think certainly in tech, possibly we're seeing multiples calm down a little bit. So perhaps valuations that people could expect a couple of years ago that they maybe can't. But like we've been saying all along, you know, good businesses, good technology that solves a genuine problem is always going to be attractive. It may be that they're just, you know, we get less kind of hugely newsworthy exits for a couple of years.
So we've actually, you've mentioned multiples again. We do have a question in about that, which may be a good time to address it. Somebody's asking, you refer to a leveling in the market. Does this have a direct correlation to investors forecasting smaller likely multiples on future investments? And is that perhaps sector dependent, I think is the meaning of the question there. Does anybody want to take that one?
I can give my view on that. I mean the answer is for BGF, and I would imagine most other investors, you know, our job is to price risk and reward. That's what we're trying to do. And BGF, we are a volume investor. We invest across a range of sectors, a range of size of businesses, and a range of risk profiles. So what that ultimately means is there isn't really a one size fits all. We need to make X on every investment. It's we need to make X on this particular investment because that matches the risk profile. So I think what the current market is doing, it's just causing investors to think harder about making sure they price that risk in. But ultimately, if we do that correctly as investors, then we believe that return should still be where where they were before this uncertainty. But it is an environment that is uncertain, and it is you look forward and it feels like there's a long way to go before we're in a period of sort of economic stability, if we ever do return to that. I mean, it feels like so long ago since we had that. So you're just aware of that. But ultimately, as I say, it is our job to price risk, which may mean that we don't do some investments that we would have done pre all this economic turmoil.
We're now about halfway through, just as a time awareness to everybody. So do keep the questions coming. If we don't answer them during the course of the panel, we will try and get through as many as possible at the end of it. Adrian, what's the perspective from the banking sector on M&A at the moment? Is it similar to what we've been hearing?
I think so. I mean, the lending market, has changed massively over the last 10 years. There's a huge range of finance providers out there. I think what we see as a senior debt lender in the main, we see more opportunity for ourselves at this point because cost of borrowing has increased and because investors still have a huge amount of equity to invest in their pockets. They're trying to find the right opportunities, but perhaps not leveraging them as aggressively to putting such a burden on businesses from a cash perspective on interest costs than may have been the case in the very benign environment that we've previously been in. So we're seeing a great opportunity for our business. As that alignment comes back perhaps more to senior debt markets than debt fund markets, but clearly there's such a wide range of financing options still available to businesses and investors that I think that's a good catalyst for getting deals done and supporting M&A volumes, both locally, nationally and internationally.
And if I can stick with you for a moment, what about the appetite? We've heard quite a bit about the appetite from investors. What about the appetite from debt markets?
Probably outside of my area of expertise to some perspective, where you start talking debt capital markets with Santander, the corporate business is very much about lending and retaining that rather than underwriting and selling down investment. Well, I guess the piece I sit in. But I think wider markets is still there, but difficult for me to comment, to be honest.
And I think you had some views on international trade as well.
Yeah, well, we see that. We're clearly an international bank. Santander operates in many jurisdictions around the world, and one of our big pushes in the last 5 years or so has really been to support businesses in expanding internationally. A lot of people have spoken earlier around stability and recurring revenues and that kind of wide offering and really building momentum in growth and sales. And we see that international markets for UK businesses exporting is a huge area, and Santander has put a lot of investment in products to support businesses. We launched a platform middle of last year called Santander Navigator that really helps to support businesses try and find suppliers or customers overseas to widen their base of exports, and I think that's really important because there's so many different economies around the world that if you're able to do that, it should drive more stability for the UK businesses.
James Foster, do you have any views on sort of the way the year may go? What might we expect out of Q1, Q2? What might we expect later in the year?
Yeah, I think Q1 might start quite slowly. I think there's, I think locally there are a number of processes and corporate finance processes that are looking to kind of kick off, and the corporate finance guys that we tend to speak to, the likes of the Clearwater guys and others, appear to be busy doing lots of pitching, which usually means that we've probably got a 2 or 3 month lag until those processes really start to gather some momentum. I think that we could be in for a slower Q1, possibly Q2, but I think towards the back end of the year, I think those deals will come through. I think there's a lot of PE investors who've done very well over the last few years and have got some great businesses away, who are sat on funds that they need to deploy. And I can see as the year progresses that those PE guys will press the button on some of those exciting new opportunities and deals. So I can see maybe a slightly slower start to the year, kind of reflecting the good sort of 2021/2022, and then a really kind of business as usual towards sort of Q3, Q4.
James Croxon, you're nodding, and as soon as James Foster started answering that, I thought that's a beautiful pass from the wing out towards the box there. So,
yeah, well, I would echo everything that James has said. I mean, in terms of our, if we look at our WIP, it's as high as it's ever been of businesses that want to transact. Now, look, not all of them will transact this year, and we'll not bring all of them to market this year, but it certainly, to me, suggests that there's going to be a high volume of activity. But again, like James said, we were kind of actively kind of pausing and taking stock of deals maybe in Q4 last year, because there was a lot more kind of uncertainty around then. And therefore, those deals that didn't launch then, that is kind of driving the reason why the start of this calendar year may be a little slower. But actually, that doesn't mean that we as kind of corporate finances aren't busy, because we're busy getting prepared on deals that we will be bringing to market later on in the year. So, I do sit here, confident that the kind of page 2 of this year is going to be pretty active from a M&A perspective.
Amy, do you have any thoughts on that?
Yeah, no, I agree with everything that's been said so far, really. we have come out of, like Barry said, I don't really remember kind of normal times anymore. We have come out of some quite tumultuous times. So I think, you know, as everyone starts to gain confidence again, things will pick up, and you know, there do seem to still be a lot of pitches out there, a lot of work to be won.
Barry, you're nodding.
Yeah, well, I would agree without repeating what everyone else has said. And you just look at some of the macroeconomic forecasts. You know, inflation does come right down to 3% by the end of the year. I mean, you know, you'd hope that's going to then filter through into increased consumer confidence, increased business confidence. There's also the crisis in Ukraine as to where that ends up, and you know where ultimately energy prices level out. So there's a lot to happen over the next few months. But hopefully the big thing for me is inflation, because it just permeates its way through every single business, but hopefully the government can get that under control, or the Bank of England. I don't know quite who's in charge of it or not. I'm sure they'll all claim victory. But if they can get that under control, I think that will go a long way to increasing business confidence.
And James Foster, I think you've had quite a look at the confidence aspects of the markets at the moment. How much does investor sentiment really play a role in this? I mean, we can all look at fundamentals and what have you, but how much does their mindset affect the market?
I think it plays a huge role, whether you're talking, you know, the FTSE 100 or down into kind of the local attitude and the environment that we're in doing kind of deals in Yorkshire. I think it really needs everybody to be quite robust, quite pragmatic, and really kind of focused on getting back to the basics of, you know, good businesses are still good businesses despite, you know, inflationary pressures. You know, you kind of back to the basics of the balance sheets, the accrued revenue, income streams, etc., and they don't fundamentally change. So I think getting back to basics, I'm feeling quite confident that there'll be some great deals to be done this year.
We have some more questions in from our attendees. Are there any particular sectors that are currently hot? And conversely, what sectors look out of favour? And has that changed from the pre-COVID period? Who wants to field this? Amy, that might be something you could look at on the SME front for us. Are there changes? What's hot? What's not?
Yeah, I mean, you know, tech really is you know, still on a hot trail. Like I said, there's more investment in tech now than there was pre-COVID. I think there was a lot of innovation that was born out of the pandemic that has led to businesses coming along. And then I'd say, kind of on the other side of that coin, for me, what's maybe not so hot now is like the more traditional kind of retail and consumer, maybe some of the hospitality. It's seen as still something that is a little bit more fallible.
And they I think we're all aware they took quite a hit during COVID, didn't they?
I'd always look more at business fundamentals and really the attributes that any individual business has, perhaps more so than sectors at times. You know, it comes back, we keep saying around stability and repeating recurring revenues, but you know, there's so many different sectors that have those attributes, and you know, I think that's what's key for you know, being able to forecast with confidence, you know, and being able to leverage those earning profiles. But yeah, having said that, there's obviously sectors that is more attributable to. But I think there's always, you've got to take note there's winners and losers in every sector. Competition is right. But I think it comes down to, you know, the quality of advice and the investor base. And we're very lucky as a region. We've got a lot of investors and PE and lenders who in advisory markets that have been around for a long time now and got experience through all cycles. So it's really drawing on that experience that's important for me.
James Croxton, you're nodding there, is it?
Yeah, well, I'd agree. I think obvious, the whole kind of cost of living crisis and pressure on individuals' wallets, means that I certainly think deals in kind of direct to consumer businesses may be challenging, particularly if you've got particularly if there's nothing kind of niche or specialist about the product. But actually, that sector specifically seen a change in the last, during COVID, people stuck at home. Actually, loads of people were buying stuff online, spending stuff on the house. So that sector went through a bit of a, there was lots of deals and quite high valuations, and then definitely has seen a drop. So it does. Sectors do ebb and flow depending on kind of what is going on. But I'd agree that a good business is a good business, kind of regardless of where it sits. It might be having a specific issue at any point in time, whether it be with its supply chain because something's happened or outside of their control. But ultimately, if it is a good business, they will be able to weather that and come out the other side stronger. Particularly versus some of its competition, which might not be able to, weather specific storms, and those businesses will always remain valuable, and actually will gain market share if we're doing all the right things properly, even through tougher periods.
We're questioning from Danny Preston: how will the trend of keeping old borrowings on the books instead of rolling them into loans affect the valuations and deal making in the current market conditions in the Northeast? Or is this not being seen much in this region? I'm not sure who's best to throw that one at. So somebody volunteer.
Well, I'll have a go. I think it's. I don't know. I'm just trying to interpret the question. If the question is just rolling old debt, if you interpret that as you can't raise more debt, then I would suggest that ultimately, that potentially does go to valuation at some point. It's a bit less relevant, I have to say, for BGF because we don't typically leverage up our investments, but that's what I would interpret. Ultimately, if you're carrying debt of X, whereas pre this economic turmoil, you could go out and raise X plus 10. If you can't raise that plus 10 now, then potentially that could have an impact on valuations if you sell into a financial bidder. Less relevant for trade, I would suggest.
We have another question in from Dave at Gifford and Partners. Is there still an appetite for second and third time investments? Some of the panel typically target small to medium size investment, but are first round funding still likely to be more in demand by investors? What stage are you at?
Look, I think there is definitely still appetite for secondary and tertiary buyouts, without a doubt. If you think if a company has already been through or is in its first round of private equity, then in general, it will have been professionalized to a point. They know how to operate with PE. There'll be a good management team. Will have been through the process once before. So actually, those businesses are as attractive as they ever have been, and and will continue to be to the next round of PE. And it all again just depends on the growth dynamic. Is there still enough growth within that business to kind of deliver a PE return for the next buyer? So no, there's definitely appetite out there from private equity to do secondary and tertiary buyouts without a doubt.
Question from John Jones: is there much evidence of overseas interest in investing in businesses in the region? Adrian, is that something that you would?
There always has been, and I think there always will be. Weak sterling is a driver of that to some extent. I think we see it both ways, and always have, and always will. I think Croda was in the press this morning, wasn't it? That's obviously got overseas investment. The local success stories, but there's a huge range of have had investment from overseas and then come back to UK ownership and vice versa. You know, and there's good evidence of Yorkshire businesses acquiring overseas as well and expanding in through acquisition in Europe or wider. I think it's there always will be. And, the global markets become smaller as technology continues to improve. We've seen that in our
James Foster, I saw you just moving towards answering that as well.
Yeah, I think there is. We're seeing a lot of interest from US acquirers at the moment, and I think as well. I think Yorkshire as a region is it's a bit of a hotbed for whether it is the fantastic universities that are here, the labour, a pretty highly skilled professional labour force. People tell me Leeds is the second city to London for legal. I'm not sure that's still the case, but it's a good line to certainly trot out particularly when you're over in the northwest. So yeah, I think there is a lot of interest in Yorkshire-based assets, and I think there's a lot to be sort of proud of, and a lot of reason and rationale why overseas acquirers might look to Yorkshire, really.
I'm certainly seeing a number of companies who are either opening or in the process of opening up offices, or even if it's a single person, to be in the region. James Croxon.
Yeah, look, we absolutely. I don't know what the stats are, but I suspect from from an M&A perspective in terms of trade, selling businesses to trade, it'll be, I'd be surprised if it wasn't up to kind of 40-50% of the deals we do are sold to an international buyer. There's loads of private equity that are founded. The head office will be international, whether it be from the US or Europe. A lot of them actually have offices now in the UK and are targeting assets, but it is investment from further afield. So as Adrian has said, there always has been, and I think there always will be, appetite from international investors to invest in the UK, because we've got lots of good businesses.
I think that's both trade and private equity.
Yeah.
We've seen US private equity invest in a number of businesses in the region because they've got specialism in a sector, and they've seen good opportunity to deploy, in the UK and more particularly Yorkshire and the Northeast, to drive the exact same process they've perhaps seen in the US in consolidation or whatever it may be over the last few years, and run the same initiative in the UK.
We have a question in from Amy Salt. Are you coming across many cases of public to private requests? I appreciate the IPO flurry of the last few years has reduced. Who wants to take that one?
I think it's difficult for a lot of us to comment properly, given the compliance around any IPO or public to private that we're working on at any given time.
That's fair enough. Now, we have a question in here. Why isn't anybody talking about the impact of a recession? I suspect that we actually have. We've been talking around it quite a lot. Does anybody want to field that one directly? We've talked about positive sentiment here and interest rates going down. So I suppose the other aspect of that really would be productivity. Does anybody have any views on where productivity is going?
I mean, I can comment on the recession point. So I think almost it can be a bit self-selecting, can't it? That we're seeing businesses that clearly think they're in a position to raise funding or sell or whatever that might be. So it's a bit self-selecting in that perspective. I think what BGF has, we have a portfolio of 300 plus companies. They're across every sector except financial services in the UK, and it's very much SMEs and lower to mid market. So it's a pretty good barometer, really. And there definitely are some challenges. it'd be wrong to say there aren't some businesses that are finding it particularly tough at the moment. But equally, there's enough businesses that are finding opportunities and growing quite strongly. So across the board, in a sort of taking a more diversified view, I think it was a comment that someone made earlier about the sort of media, the sort of messaging from the media. It doesn't. That's not quite what we're seeing. It's not sort of the end of the world is what you kind of think it is by the sort of constant news flow. I'm not saying for a minute it isn't tough, and businesses aren't finding it tough, but equally there's a lot of entrepreneurs that are seeing this as an opportunity, and actually they're focusing on their own businesses, they're focusing on where they can invest, and expecting to grow this year.
Yeah,
and I think as well, I think there'll always be M&A is all about winners and losers. Yes, we are probably all seeing more distressed deals than what we saw 2 years ago, but there's still deals, and it's still M&A activity. So pricing may change, but there's always going to be opportunistic moments to acquire companies or to sell companies. So pricing may change, but that doesn't necessarily mean that M&A activity is going to dry up just because there is the very strong winds of a recession.
Amy, do you have any views on that?
Yeah, I mean, I think I'm too young to remember the last recession. Well, I certainly wasn't working where I am now, but it definitely doesn't really feel in that same way, in that there do still seem to be a lot of genuine opportunities for deals. There is still a lot of money out there. So yeah, while it would be wrong to kind of ignore the recession altogether, I think it does feel quite different in terms of deal flow and economically.
Yeah, I think the last time we had a big recession, actually we did, you could argue that certain of the kind of banks and funders, there wasn't the money there, it wasn't available. In the last 2 years, the amount of private equity and debt funds that have raised new funds and bigger funds than they had before, there's an absolute wall of money out there that needs to be invested, because they can't sit on it and do nothing. They have to invest, and therefore, they may be more selective and they might take a bit more time to make a view, but they are going to continue investing that cash because they have to, because they're on, they're kind of on set returns from the people that they've got the money from and generate the funds from. So, that's why I think it will be slightly different this time around, because there is money out there that needs investing.
And I think it's about buying into that partnership you're going into with private equity to some extent, for the management teams and entrepreneurs, and what value private equity can add going forward. And regardless of availability of credit or enterprise value, it's about what can you achieve in that partnership. But I do agree with James. I think there's a huge amount of liquidity out there from lenders and from equity, and that will continue to drive positivity and investment.
So if we can sort of just go around, we've got about 5 minutes left, with about a minute each. Just to recap, what are the salient points that you would like people to walk away with? James Croxon?
Yeah, I mean, the biggest point for me is just around having, look, we are in a challenging environment. There's lots of, we are entering into a recession, but I think there's lots of reasons to be positive out there. Particularly in Yorkshire, we've got great businesses, we've got growing businesses. And as we said, there's lots of money looking for a home in good solid businesses. So I think just be optimistic about the outlook for this year from an M&A perspective, definitely.
James Foster?
Yeah, I'd echo the optimism to an extent. I think we'll see a rally in the second half of this year, and I also think deals may take longer, but I think there is that desire to deploy capital, and I really think that will continue. I think corporates are sat on money. I think PE's raising record amounts of cash. So that capital will need to be deployed one way or another, which will drive M&A activity.
Amy?
Yeah, I think there's loads of reasons to be optimistic, particularly around the tech environment in the north. We've got a fantastic regional tech hub, which a lot of people have worked really hard to establish over the last couple of years, and we're really starting to see the benefit. Already this year, North Invest have had their first exit. And we've also seen the recent investment by Northern Gritstone into slingshot simulations. So, you know, this stuff really is working. I also think there's been a real push towards kind of promoting female founders as part of the ESG agenda, but also generally. So, you know, not only is there plenty of money to be deployed, but it's also hopefully being deployed more fairly. So, yeah, I'm coming into the year very optimistic.
Barry?
Yeah, I think a similar sentiment. The only thing I'd add that, you know, deals are going to be harder at the moment for a whole raft of reasons, whether that's the trading environment, the market environment, and stakeholders. And by that, I mean management teams, I mean investors, I mean advisors. People just need to work harder, work together to an extent to get things done. And if there's a sensible, you know, for us, if there's a sensible ask, then we'll probably be able to deliver a sensible answer. It's when there's not a sensible ask and, you know, sort of not necessarily an acknowledgement of some of the challenges that are out there, that's when it's quite hard to move things along. But from what we've seen, certainly on the deals we've done recently in Yorkshire and the Northeast, it has been that sort of sensible approach. I mean, management teams are not sort of ignoring the fact that it is tough out there, and for us, that's fine. We'll just you know, we'll find a way to structure it accordingly, hopefully.
Adrian?
Yeah, I'd agree with what everyone else has said. I think there's really is reason to be positive about the outlook for 2023. You know, I think fundamentally businesses with, you know, strong performance metrics, market position, growth prospects will always attract significant appetite and competition. And, you know, as James was saying, you know, the investors have got a lot of dry powder to invest, and they've got significant resources. And, you know, when you couple that with a wide range of lender options, and I think you know, that there will be deals done and you know, investment seen in the region, which is clearly positive.
We do have a couple of late questions in. I don't know that we have time to answer both of them. I'm also told that the software will boot us out on the dot of 1 o'clock. So before I ask the panel to address either of the questions, I would like to thank James Croxon, James Foster, Amy Pearshard, Barry Jackson and Adrian Rolls for giving us their time today. I would like to thank Clearwater International for helping make this webinar possible. And I would like to thank everybody who's attended and asked a really excellent set of questions for the panel. Dave, I think your question might be the one that we don't have time to get to. The must-have factors to have in place are going to be quite extensive, I think. But Greg McDermott is asking, is the environment set for investors and private equity houses? Is the setting right for them to get bargains in a downturn and to drive values lower? Now, I think we have addressed the downturn aspect of it and how that might affect pricing. But is there an activist element in this? James, you're smiling there. James Foster.
Yeah, I think there's such tremendous competition for private equity investors these days. There's new funds being raised. There are people hiving off from other larger PE houses to go it alone with further institutional backing. So I think that competition will prevent that kind of activist behaviour, is my view.
Yeah. Any moment now, we are going to get cut off. I'd like to thank everybody for attending.